Most people buy a stock only because it is going up. When the stock crashes and bad news start to fill up the internet, they become more and more emotional, and eventually, they sell the stock at a significant loss in fear of losing even more. Does this story sound familiar? In reality, a stock can be sold at a price far from the intrinsic value of its underlying company, and finding the intrinsic value of a company is key to investment success. In this video, I will tell you the exact steps to do this using the DCF model. The legendary investor Warren Buffett has recommended this method in one of his lectures, and it has helped me outperform the S&P 500 index across all my portfolios. As usual, you can check my past performance using the links in the description below. And don't forget to subscribe to the channel so you won't miss out on profitable investment techniques that I will be sharing with you in the future.
If you buy Coca-Cola today, the company is selling for about $110 to $15 billion in the market. The question is, if you had 110 or 15 billion, you wouldn't be listening to me, but I'd be listening to you instead. But the question is, would you lay it out today to get what the Coca-Cola company is going to deliver to you over the next 200 or 300 years? The discount rate doesn't make much difference after as you get further out. And that is a question of how much cash they're going to give you. It isn't a question of, it isn't a question of how many analysts are going to recommend it, or what the volume in the stock is, or what the chart looks like, or anything. It's a question of how much cash it's going to give you. That's the only reason. It's true if you're buying a farm. It's true if you're buying an apartment house. Any financial asset, oil in the ground, you're laying out cash now to get more cash back later on. And the question is how much are you going to get, when are you going to get it, and how sure are you? And when I calculate intrinsic value of a business, when we buy businesses, and whether we're buying all of a business or a little piece of a business, I always think we're buying the whole business, because that's my approach to it. I look at it and say, what will come out of this business and when?
Here are the key ideas mentioned by Mr. Buffett. The first idea is easy to understand, but the other two lack details. In the next few minutes, we will fill in the gaps and go over the exact steps on how to apply them to real companies. It is important that you watch the entire video to properly understand the whole process. The world of business is ruthless, operating on the principle of survival of the fittest. It is a loser's game to try and predict future cash flows for weak businesses that have no means of protecting themselves. They will be gobbled up by their competitors in no time. To ensure our long-term investment success, we must find exceptional companies that satisfy at least the 5 criteria listed on the screen. Our research requires 10 years' worth of financial data. I personally use a paid service called Stockunlock that provides everything out of the box, but you can also get the data for free using a website called quickfs.net. I will share the links in the description below. Businesses with solid economic moats sit at the top of the food chain. They are well known to everyone, few in numbers, and extremely hard for new companies to compete with. Economic moats are easy to identify once you know what to look for. The 4 most powerful moats are network effect, barrier of entry, economies of scale, and high switching cost. Network effect. This is a phenomenon whereby increased numbers of participants improve the value of a service. This applies to industries such as social media, payment processing networks, and platform businesses such as mobile app stores. Remember, the largest networks always benefit most from the network effect, while smaller networks usually find their customers stolen by their larger competitors. Barrier of entry. Companies operate in industries that are extremely difficult for new entrants to penetrate. The barrier could come from intense capital requirements, such as railroad and utility companies, or from technological sophistication such as the software and chip manufacturing industry. Economies of scale. Dominant businesses sell such high volumes of products that they can significantly lower their per-unit costs to levels most competitors cannot afford. High switching costs. This usually apply to companies providing complicated products that are extremely expensive or time-consuming for the clients to switch to a competitor. There are 2 steps to discovering the moat of any company. First, we need to read the business section found in the company's annual report. I will use Visa as an example. The annual report can be found on Visa's Investor Relations website. Let's download the latest annual report. And under the table of content, you can easily find the business section. Make sure you read the entire section line by line to gain a good understanding on how the company operates. Annual reports for all companies are structured in a very similar way. Next, we must try to understand about the product or service a company provides. If it is a restaurant, have a dinner there. If the company creates software, try to use it. And while doing it, think about whether this company has any of the economic moats we just talked about. Consistent or accelerating revenue growth is a solid evidence of the existence of economic moats. When plotted on a chart, you should see a nice line going up from the bottom left to the top right. If the revenue is slowing down or fluctuating wildly, it usually indicates raising competition, declining industry, or an existence of business cycles that may inflict periodic losses to the company and to us investors as well. Here is a rule of thumb. A company must have consistently grown its revenue over the past 10 years to be considered, with an average growth rate of at least 5%. A 1 or 2 year occasional decline is acceptable, given that the company can recover quickly after, so that the overall growth rate is still above the required 5%. EPS growth ensures a business has a profitable business model. In the end, investors can never make any money if the company doesn't. Countless naive investors has bought into exciting stories of unprofitable companies, only to see their investment plummet, while making the company executives filthy rich. I personally only invest in companies with an EPS growth of at least 10% annually for the past 10 years. The consistency of growth is not required, as there could be one-time expenses such as legal fees and investment losses that will make the earnings fluctuate quite often. ROIC, or return on invested capital, is one of the most important metrics to identify a superior business. A high return on invested capital indicates the management's exceptional ability to continuously reinvest new capital at a high rate of return. This is a reflection of continued successful business expansion and product development. We demand an average ROIC of at least 10% for our investment for the past 10 years. The higher the better. Let's admit it. As retail investors, we lack knowledge and information compared to professionals who live and breathe the market every single day. That's why we need leverage, taking advantages of hints and evidence provided by the pros. I'm not telling you to hand over your money to the banks or financial advisors who invest your money for their own benefits and suck you dry with humongous fees. I'm talking about free and verified information online that is just a few clicks away. In the US, all hedge funds larger than $100 million must submit 13 F filings every quarter to disclose all of their holdings and trading activities. There is an amazing website called dataroma.com that organizes the data from the 13 F filings, telling you exactly what stocks are being bought and sold by a selected group of market-beating super investors. This data always has a delay of 3 months, so we must only follow long-term investors who rarely make big changes to their portfolios. If multiple long-term focused fund managers hold your chosen stock in significant amounts, at least more than 5% of their portfolios, that is a strong indicator of the stock's potential. Here are some super investors I'm personally following. Another way of using leverage is by paying attention to the insider ownership. I use a website called simplywall.st to find this information. If the CEO and other top executives is holding a large stake in their company, or if they have purchased large amount of stocks recently, that is a good sign that the company will perform well. I would consider the amount meaningful only if it exceeds 2 times annual salary of the insider who holds the stock. Here is a summary of what we just covered. Make sure to right-click and save this timestamp so you can always come back to review them. If you're still watching, it means you have a genuine passion for investing. You are destined to become wealthy because you will soon learn how to find the true value of a stock. So far, we have learned how to identify companies that will generate predictable cash flows in the future, making them ideal candidates for the DCF model. I don't want this video to become a math lecture, so I won't go into the details of how the DCF calculation works. There are many free calculators available online. Instead, I will focus on what truly matters: the 5 input parameters required for the DCF model. Dilution happens when a company prints more stock shares to raise capital, which reduces our ownership in the company. This is only acceptable if the company does it in moderation, while also having a growth rate much higher than the rate of dilution. Ideally, we want this rate to be 0 or negative. Free cash flow is the amount of money a company can freely return to its shareholders every year after covering all costs. We need to find the average free cash flow growth rate of the past 5 years for our company. This rate has to be higher than 10%. There are 2 important catches to keep in mind. First, we must avoid being too optimistic when estimating the growth rate because many unexpected future events can negatively impact our company. One way to stay conservative is by finding the free cash flow growth rate for the past 3 years and compare it with the 5-year growth rate. If the growth has slowed down, use the smaller number. Second, if the rate of growth is exceptionally high, say more than 20% per year, it is likely temporary and will eventually slow down. Projecting future cash flow with such a high growth rate will result in an unrealistic stock valuation, which will eventually crash down. I personally use a maximum growth rate of 15% to value any company. The price to free cash flow ratio is calculated by dividing the market capitalization by the free cash flow. We shall find the average price to free cash flow ratio over the past 5 years and 3 years and use the smaller number. The maximum ratio I will ever use is 30. Anything higher is risky, as it would have assumed too much future growth and leaves little room for error. Discount rate is the rate of return we demand from our investments. I always use 10% for the DCF calculation. You are free to use a higher discount rate up to 15%, resulting in a more conservative valuation, but doing this will exclude most of the top companies. Remember, it is far better to buy a wonderful company at a fair price than a fair company at a wonderful price. These data can be easily found by visiting the Yahoo Finance website. Type to search for a stock and click on the Financials tab, then click on the cash flow statement. On this page, you can calculate the free cash flow by subtracting the investment in property, plant, and equipment amount from the net cash provided by operating activities. Next, we can find the total shares outstanding by clicking on the Statistics tab. You have made it. You have now gathered all data required for the DCF model. Now simply plug them into any discounted cash flow calculator to get the intrinsic value for your choice of stock. I personally use the DCF calculator on Stockunlock. In case you don't have access to it, I've also prepared a Google Sheet template in case you couldn't find any free tools online. You can find links to both calculators in the description below. By the way, if you wish to level up your wealth into the next level and unlock the ultimate freedom, make sure to show some love by hitting the like and subscribe button. See you next time.